have already predetermined are the indications I want to make on the slides, the notes I want to make on the slides. So I don't want to have to sit here and have to remember where I put those genius marks. So okay, so let's just go ahead and we're going to start out, even though this particular chapter is focusing on testing, sampling that we'll use for testing of internal controls, something called attribute sampling. We're going to start out with some more basic definitions that are applicable to audit sampling in general. Okay, so when we use sampling, it's important to understand that auditing standards permit both statistical and non-statistical sampling. Okay, the couple of things that you see in some of your questions in your homework and whatnot that might be a little confusing is they always try to make you think that you must use statistical sampling. You can use statistical or non-statistical sampling. Sampling means that we were simply going to look at a less than 100% of the items in a population of the transactions making up an account balance, whatever. And you can use either a statistical method or non-statistical method. The beauty of statistical method is that it's going to allow you to quantify just how precise your conclusions are based on your audit sample. Whereas with non-statistical sampling, you can't talk about things like confidence intervals, you can't talk about ranges, precision, that sort of thing. You just would draw your conclusions, but you can't quantify how precise you're being with your conclusions. With statistical sampling, we can quantify. We are 95% certain that the account balance does not exceed X, and then have that determine whether or not we're going to qualify our opinion or give an unqualified opinion. Okay, now I point out this particular slide because with the increase in computing power, automated software and whatnot that auditors can use now, it is often not that we don't even have to use sampling, okay, that we can test 100% of the transactions because of the computing power and the ability of these software to get all of the transactions from a client and look through all those transactions for specific attributes and whatnot. I'm sure most of you have heard about the data analytics class that Golden Gate has now. I recommend that if you have the opportunity to take that in your schedule, or if you're now in the MSDA for data analytics, you will be taking that class, and we talk more about those sort of techniques, both from the standpoint of using it for tax and for audit. So we don't get too much into that in this class, but just know that these days audit sampling is not always necessary when you can sample 100% of the transactions. So when we talk about audit sampling, we're going to be talking about looking at less than 100% of the transactions, even though there's software that allows you to look at 100% these days. Now, the other thing that you'll see in some of the homework questions that they always try to trick us into when we're talking about sampling is that audit sampling replaces auditor judgment. Nothing replaces auditor judgment. Let me repeat that. Nothing replaces auditor judgment. So just because you pull a sample and a sample indicates something to you, it's not like you become a zombie and just go along with whatever that sample indicates to you. The auditor judgment will always be the last stop. Okay, so let's just go ahead though and start to take a look at some of the key terms that we're going to be having to know the definition for. So we have audit sampling. Audit sampling means, again, we're looking at less than 100% of the transactions when we do our audit. Sampling risk is the risk that the sample will not be indicative of the population. Anytime you use a sample, there's always a chance that that sample will not be indicative of the true condition of the population. Confidence level tells us how sure we are about our conclusions based on the sample. And there will never be, a 100% confidence level. It's always something less than 100% because there's always a chance that based on the sample, we could be wrong. The sample could always be different than the population. Okay, and then tolerable error is the amount of error or deviation we'll accept without determining that we have either not supported the assessment of our control risk or we have a material misstatement. Expected error comes in the form of expected deviation or expected misstatements. What is the expected deviation from a control? What is the expected error in the account balance? And all of these terms we're going to be going through, defining here and seeing how these items, particularly sampling risk, confidence level, tolerable, and expected error, affect our sample size. That's going to be a major takeaway from this discussion today. Okay, so again, audit sampling means that we're going to look at less than 100% of the items in a population. And now we hope that the sample is representative of the population, and that therefore will provide a reasonable basis for our opinion. And we say reasonable basis because, one, there's a chance that our sample is not indicative of our population, but we will also see, as we've learned already, frankly, that there are non-sampling factors that will affect our conclusions and possibly have us making the wrong conclusion. Okay, now when can we use sampling for both our control test and our substantive test? And you can see that for the most part, you can use sampling for reperformance, recalculation, confirmation, analytical procedures. Remember, we learned we're what? Sitting there and looking at, say, what we think the washing machine revenue should be based on the gallons of water that we use. There was really no sampling that was there. We simply came up with an estimate, came up with a range that we would expect that our estimate would fall into, and then if it fell outside of that, we had to do additional procedures, inquire of management to try to explain those differences, etc. All that was what we talked about for analytical procedures, but you can see there's no real sampling that's there. Scanning, looking for an unusual account balance. Again, you don't sample, you would probably ask your software to look for every transaction, look for amounts over certain dollar amounts. So when we're doing this, observing, inquiring, you're not using sampling. But for some of these others, we will definitely be looking at sampling. For example, inspection of records or documents. Let's say that our client tells us that the supervisor signs off on all the time cards. Well, what are we going to do? Let's say over the course of the year, our client uses 10,000 time cards. We're not going to sit there and look through all 10,000 time cards. We'll be there for the rest of our lives trying to see if the supervisor signed every single time card. So what will we do? We'll pull a sample of time cards. We pull 100 time cards and we'll look at those 100 time cards to see if the supervisor signed off on it. If it did, the supervisor signed off sufficient amount of times, then we could assume that that control has an operating effectiveness. We will make our assessment of control risk at less than the maximum. Timing, extent, and nature of our substantive procedure. Nature, we're going to probably use internal evidence instead of external evidence. Extent, smaller sample sizes. Timing, doing interim testing instead of year-end testing, because based on our sample, we concluded that the control risk was less than the maximum. Now, we could have pulled those sample of 100 time cards, looked at them, and found there was way too many where the supervisor didn't sign it. So then we're going to say, you know what? This control does not have operating effectiveness. We're going to assess the control risk now back up to the maximum. Now, when we do our substantive testing, nature, we're going to probably be using external evidence instead of internal evidence. Extent, for our substantive testing, we're going to take a larger sample size. And we're going to see that our assessment of risk and material misstatement will determine our sample sizes for our substantive testing. And then timing, we'll probably do year-end testing instead of interim. Okay, so for some of these, sampling works. Others, you're probably just going to look at all the items in the population and get a sense if any of them fall out of a certain tolerance level. Okay, so you can see examples where you will use sampling here. Inspection of assets. Yeah, you may not look at every single asset. Inspection of records and documents. I just gave you an example there with the time cards. Okay, reperformance. Remember, we said that reperformance is where the auditor goes in and actually reperforms a control that the management has implemented to help prevent or detect a misstatement. I think in the example we had with the sales account, we were looking at those sales logs and seeing if they actually called some customers outside. And remember, I said we actually participated in a few of the calls where we called the client's customer to see if they were satisfied with the goods, and check the quantity bought, the dates that were bought, how much we bought, that sort of thing, the product number that was bought, that sort of thing, verifying therefore that that sale actually occurred, right? Because remember, we lined up our audit procedures along with the assertion, so existence, occurrence. We did that procedure. Well, that was reperformance of the control. That reperformance of the control, remember I had that pyramid up there, is the best control procedure that you could use. So again, when we're trying to lower that control risk, get it below the maximum, maybe go from medium to low, we're probably going to have more reperformance. Remember that pyramid had reperformance at the top, less inquiry. Remember, inquiry was at the bottom. And we would use larger sample sizes, what we're talking about in this chapter, for our attribute test, for our control test in that example. Okay. Confirmation, same thing. You probably wouldn't confirm all account balances. That's going to be difficult. Although with the data analytics software, you might be able to do something like that. But for the most part, we're going to probably pull a sample, use that sample to do the confirmation of account receivable. Okay, good. Now let's talk about stratification. Okay, what an auditor would most likely do is do testing on certain items that meet certain criteria. In other words, we look for the large dollar account balances and we're going to pull those off the top and we're going to audit those. What that does is allow us to be more efficient in how we're using our audit resources. So if you take a look here, I gave you an example of accounts receivable. Let's say we have some really big ones at the top. You see those 5 big ones at the top, one for 10,000, another one for 10,000, 3, 4, and 5 are each 5,000 there for a total of $35,000. Now let's say the total account balance, you can see here, is 100,000. The total account balance is 100,000. Guys, I'm not going to write 100 numbers. So just use your imagination that items 6 through 100, the remaining 95, total 75,000. So you have, well, actually, hello, John, you might want to do your math a little better there. That means the remaining would have to be, would have to be 65,000, right? Am I doing my math right? 65 plus a 35 would be the 100,000. Okay, so the remaining 95 items are totaling 65. Those top 5 have a total of 35,000 for a total of 100,000. 35 plus 65, 100,000, right? Now notice we would pull off those 5. I'm assuming we're going to pull those 5 out and we're going to look at all 5 of those. So in effect, we're only looking at what? 5% of the items in the population. But if you look at dollar balances, because remember, we're looking at what the dollar amounts embedded in this assertions, we are going to be looking at what? 35% of the dollars while only looking at 5% of the items. This is called stratification. Stratification means pull those big ones off the top, send out a confirmation for all of those. Now, does that mean that we ignore the remaining 95 items? No, for the remaining 95, now we'll probably pull a sample, send out confirmation letters to whatever the sample size would be for those remaining 95, and both that was stratified piece of the sample plus our stratified piece of the population plus our sampling piece together would be used to help us form our conclusion about whether the occurrence assertion was fairly stated in the financial statements, the accounts receivable account. Any question on that? Okay, that's called stratification. You pull off some of the big ones, look at those big ones, get a sense as to what's going on with those, and then you use sampling for the remaining smaller ones. And it's a question of auditor judgment as to where you draw that line. Okay, I'm going to assume the rest of those were amounts that were fairly small that totaled up to that 65,000. Okay, and I have no idea what those 2 monsters looking at each other have anything to do with this. Okay, all right, now you take a look. And when we talk about our control testing, remember guys, we had general controls and application controls. General controls, you probably can't use sampling to test general controls, because general controls are things like what? Things like penetration testing. Can I hack into the client system? Do they have proper disaster recovery? You can't really sample your disaster recovery techniques. You just look at those to see if they are effective or not. Okay, whereas application controls, you could test those through sampling, and that you could pull a sample transactions and see if the payroll controls process those correctly. So general controls, you're probably not using any sampling. Application testing, yes, you probably could use sampling to sample a set of transactions using some of those different techniques that we talked about. Chapter 6, when we talked about internal control, when we talked about using those different computer-assisted audit techniques, for example, transaction tagging. You're probably not going to tag every single transaction. We'll pull a sample of transactions that you will tag as you go through and check the application that you're using that transaction testing for. So you use your computer-assisted audit techniques more for application testing, and you probably would use sampling for that. General controls, not so much. Okay, advantages. You can design an efficient sample using stratification. I just gave you an example of that. We are going to be able to quantify the sufficiency of the evidence that we've obtained. We're going to be able to quantify our sampling risk. We're going to be able to be very scientific and precise about how we're determining whether or not we feel the account balance was fairly stated. Okay. Disadvantages of sampling, whatever. You know, I look at this and I'm like, well, too bad. I mean, these days, you're going to use sampling, and this idea of cost of training auditors and proper use, well, you're going to use some form of sampling. You're not going to look at every single transaction for many, many account balances. And so whatever these disadvantages are, I would tell auditors, get over it. You're going to be using sampling these days. Okay. Now, when we look at sampling risk, we can put them into two categories. Well, actually, as we look at our audit risk, we can put our risk into two categories. We can look at sampling risk. Sampling risk is the risk that creates our audit risk. And let's just remember our audit risk. Let's do it this way. Audit risk equals inherent risk times control risk times detection risk, right? Okay. And when we look at our sampling risk is really being affected right here. Why? Because when we do our control testing, we'll use a sample. When we do our substantive testing, we'll use our sampling. We'll use sampling. And because we're looking at what, less than 100% of the items, there's always a chance that our sample will be different from the population. So there's factors affecting our audit risk, and it's primarily affecting our CR and DR that really relate to sampling. Now, there are also uncertainties due to factors other than sampling. We can call those non-sampling risks. Examples include selecting an incorrect procedure, collusion, fraud, the client is hiding things from us, etc. Those are non-sampling risk items. And I think that those tend to, and now my arrow's in the wrong place, but those tend to affect more your inherent risk. Although you could have circumvention of controls that would affect control risk, etc. So it's not a science as to whether sampling affects control risk, detection risk. I think it does affect those, but inherent risk, I guess, could affect control risk as well. Non-sampling risk factors could affect detection risk as well, but a lot of audit risk affected by non-sampling risk factors tend to fall on that inherent risk. Okay, it's not to say that they're all on inherent risk, but I think many of them do tend to fall there. Okay, good. Now, when we look at our risk due to sampling, right? I'm saying that our sampling risk are affecting our control risk, our detection risk. Okay, sampling is affecting our control risk, our detection risk. As it relates to detection risk, for our substantive testing, we have two types of risk. We have the risk of incorrect rejection, the risk of incorrect acceptance. Now, the only thing I want you to take from this slide, okay, is that we could call the risk of incorrect rejection a type 1 risk. We could call the risk of incorrect acceptance a type 2. I just want you to be aware of that terminology. Don't worry about this long-winded definition here. We're going to give you this long-winded definition again on the next slide. Okay, but for this slide right now, I just want you to understand risk of incorrect rejection, risk of incorrect acceptance could also be called type 1, could also be called type 2 risk. Okay, now these are sampling risk related to our substantive testing. And remember, our substantive testing is affected by what? Detection risk. So since we are going to be pulling less than 100% of the items, we're not going to send out confirmation to every single customer. We're going to be sending out confirmation to a sample of customers. There's always a chance that that sample will be different than the true condition of the population. And again, we can break those risks into 2 types of sampling risk: risk of incorrect acceptance. Risk of incorrect acceptance, right, from that previous slide, is going to be called a type 2. We spell type, T-Y-P-E, type 2. And then risk of incorrect rejection is going to be called type 1. Okay, type 2, type 1 risk. Let me make sure I was consistent there, right? Okay, okay, good. Now, what is the risk of incorrect acceptance? Okay, risk of incorrect acceptance is the risk that the auditor will determine that an account balance is not materially misstated when in fact it is materially misstated. So what happens? I pull a sample of transactions, sample of accounts receivable. I send out the confirmation, everything comes back okay. I pull out of the 10,000 accounts receivable, I send a sample out for 100 of them. Based on the sample, comes back, says no misstatement. Everybody says, yes, they owe the money. I determine, okay, no misstatement in the confirmation. When in fact, if I had only pulled, whatever I said, the full 10,000 accounts receivable, only I had the time and the resources to look at every single account receivable, I would have found that indeed there was a material misstatement. So I incorrectly accepted that account balance. I have suffered the risk of incorrect acceptance. Okay, what's incorrect rejection? Incorrect rejection is I send out my sample, 100 accounts receivable confirmation. I send those out and I get a bunch back that say there's an error. And based on that sample, I determine that the account balance is materially misstated when in fact, if I had time to look at the remaining, whatever it comes out to, 9,900 accounts receivable, I would have found that there was not a material misstatement. So I incorrectly rejected that account balance. Okay, risk of incorrect acceptance, risk of incorrect rejection. Okay, now remember our sampling risk we said on the previous slide are really going to fall on that on that detection risk and the control risk. So let's see how sampling affects my control risk. And we have 2 types of sampling risk in tested controls: the risk of assessing control risk too low, the risk of assessing control risk too high. Now let me ask you this: are these mistakes made by the auditor? The risk of assessing control risk too low, too high? Is this indicating the potential for mistake by the auditor? Well, let me ask you this. I know that basketball isn't running right now. So you remember that game called basketball that they used to play? There was a big circle and they'd throw an orange ball and it would go into a net and all that. I remember that fun game. Okay. Let's say that Stephen Curry, remember him? He used to play, this guy plays on the Warriors, right? Let's say when he shoots the basket, the basketball, he shoots it too high. It goes over the backboard and everything and lands into the crowd. Did Stephen Curry make a mistake?
Yes.
He what? He shot too high, didn't he? I mean, he didn't shoot it just right. Okay. Let's say he shoots the ball and it lands, short, doesn't even hit the rim, it falls real short. He's having a bad day. Did he make a mistake?
Yep.
He shot too low, okay? So when the auditor says control risk too low, they make a mistake. If the auditor says control risk too high, they make a mistake. Why do they make a mistake? They make a mistake because there was a problem with the sample. So let's just go back to the time cards, okay? Auditor does what? Auditor says, okay, time cards are supposed to be signed. There's 10,000 time cards. I don't want to look at every single one. Pull a sample of 100. And he looks at 100 time cards, and let's say every single one of them was signed. So he says, okay, this control has operating effectiveness. When if the auditor had only looked at the remaining 9,900 time cards, he would have found that there was a bunch of times in there that the supervisor didn't sign it. So the control doesn't have operating effectiveness, but the auditor came to the wrong conclusion. The auditor says control risk too low based on the sample, right? They suffered the sampling risk there. They assess control risk too low. Conversely, assessing control risk too high, the auditor makes a mistake. Why? Based on the sample. So it happens. 10,000 time cards, I pull a sample of 100, I look through and I see, like 20 of them aren't signed. And I'm like, oh, okay, this control does not have operating effectiveness. There's way too many times the supervisor in that 100 cards didn't sign it. Meanwhile, if I had only had time to look at the remaining 9,900, maybe I only find one more in there that the supervisor didn't sign. So out of about 10,000 time cards, non-compliance with that control hardly ever happened. I have done what? I've assessed control risk too high based on the sample. I should have what? I could have probably had my control risk at less than the maximum. Question on this? This is very important right here. If I had to put a star, one of them scary looking stars on this slide, I definitely would. Question here. You got to know this stuff, guys. Okay. Okay, good. Now you take a look at this next slide and let's see how those sampling risks will affect our audit. Okay. Let's talk about efficiency. If I have suffered the risk of assessing control risk, let's start with the control risk one. If I have suffered the risk of assessing control risk too high, what does that mean? I assess control risk in the maximum based on those 100 time cards I sampled. I found 20 that weren't signed. So I say, oh, control risk is at the maximum here. When in fact, I probably could have supported a lower assessed level of control risk if I had only looked at the remaining 9,900 time cards. So what happens? What am I going to do? I assess my control risk in the maximum. I'm going to want to lower my detection risk. So now to lower my detection risk, nature, extent, and timing of my substantive procedure, now I'm going to use external evidence instead of internal. I'm going to, for nature, more effective procedure, extend larger sample sizes now for my substantive test, timing, year-end testing. I'm still going to come probably to the right conclusion there. I've expanded my substantive testing in an environment which I probably had controls that had operating effectiveness. So I come to the right answer, but I'm not very efficient because I'm using external evidence, large sample size for my substantive testing, doing year-end testing instead of interim, when I could have probably reduced the use of my audit resources because I probably had good controls. Let's say I suffer the risk of incorrect rejection, then the audit is not going to be efficient in the top part of this slide. So what happens? I sit here and I say, uh-oh, material misstatement in the account balance based on the sample. So what am I going to do? I'm going to say, well, I need to understand the magnitude, the pervasiveness of this problem. So I'm probably going to pull additional sample items to look to see what sort of adjustment I'm going to want management to make in this account balance. And when I pull those additional items, what am I going to find? I'm probably going to come to the correct conclusion that the account balance is not materially misstated. So I come to the right conclusion, but what? In not a very efficient manner because my sample gave me an incorrect conclusion, and I had to pull more items to end up determining that the account balance was not materially misstated. So in these two cases, the risk of assessing control is too high and risk of incorrect rejection, your audit is not efficient. Now notice the lower part of this slide, your audit is not effective if you assess control risk too low or you have suffered the risk of incorrect acceptance. Let's talk about assessing control risk too low. What happens? based on the sample, I look at the time cards, I say, hey, every single one of these are signed. When if I had only looked at the entire population of 10,000, remaining 9,900, whatever, I would have found that, hey, the supervisor didn't sign the time card. But I didn't find that because I based my conclusion on the sample. I assess control risk too low, so what happens? Now, nature, extent, timing, nature, I'm going to probably be using internal evidence instead of external evidence, extent, smaller sample size for my substantive testing. I'm doing some interim testing when in fact, I should have been what? Using external evidence, larger sample sizes for my substantive test, do year-end testing instead of interim. So I have not done the proper, I have not fallen into the proper response to what is an actual higher risk of material misstatement. So there's a chance that I'm going to miss a misstatement. My audit is going to end up not being effective. Risk of incorrect rejection. Risk of incorrect acceptance for our effectiveness, risk of incorrect acceptance is audit failure. I sit here and I say, I'm going to give an unmodified opinion. The financial statements are free of material misstatement based on the sample, when in fact, if I looked at the entire population, I would have found the misstatement. This audit is very ineffective. This is the definition of audit failure. I give the wrong opinion. Okay, so again, got to know actually those last two slides in concert, in that what? Risk of assessing, risk of incorrect acceptance, risk of incorrect rejection, the what? Risk of assessing control risk too low, too high, and then how they affect the audit efficiency when I have suffered the risk of assessing control risk too high, or the risk of incorrect rejection, effectiveness if I have suffered the risk of assessing control risk too low for effectiveness, or the risk of incorrect acceptance. Okay. Now, just to help with that, and I guess I put 4 stars on this one because maybe this one is a better slide for you to worry about than the previous one, because this summarizes. Okay, so you have these 2 tables. Let's start with table B down here, test of controls. Okay, and let's see what happens. Sample indicates that the control operation is okay. When the true operation of the control is okay, that's a correct decision. And you say, well, how does anyone know the true operation of the control? And the answer is nobody knows except God, I guess, knows. Okay, and so this table is being God by telling you, hey, we're God, and we're telling you the true operation of the control is okay. Okay, so I guess what happens when auditors die, they go to heaven and they say, were all those populations really okay? And if the answer is yes, the gates open up and you get to go in. If the answer is no, they pull the lever and down you go. Or maybe some people just think that auditors automatically go to hell anyway, and that's it. Oh, by the way, I have to, so here I go on one of my tangents. I have to give you the class project here because I want you to have sufficient time to look at it. And I decided what I'm going to do for that. I'm just going to ask for 1 page. If you want 2 pages, you can. Okay, but don't give me more than 2 pages, 1 or 2 pages. And I'm going to ask you to take a look at something that's happened with this these COVID-19 relief payments that went out. I saw a report in the news that my old office, the Government Accountability Office, GAO, found that there were some, I think it was 100,000 payments totaling something in the 1.2, 1.5 billion dollar range of money that was paid to deceased individuals. So I think what I'm going to ask you to do is take a look at that, okay? And see basically what the paper is going to be, see what controls you think the federal government could have used to avoid making those payments. Okay, what internal controls you think could have helped prevented the federal government from making these improper payments, paying out COVID-19 relief payments to deceased individuals. Okay, if you die, you are not entitled to a COVID relief payment. You got to be living. That is one of the criteria to receive that money. Okay. Now, what was silly about the headline I saw in the article, it says GAO recommends that Treasury recover those payments to deceased individuals. I'm like, how? I guess they're going to send all of us auditors that go to hell down there, and we're going to get the money back from these individuals that cheated, that died, that took the money. So I'm not exactly sure how they're going to get that money back, but maybe that's one of the questions you can answer. I'll put that as one of the questions you can answer in this paper. How do you get money back in these sorts of situations? I assume it was some sort of fraudulent payment that maybe went to a family member or something. I don't know. And I do know there's some ways to avoid that. And I'll just tell you right now, here's the answer to your paper, probably the best answer. There's something called the Do Not Pay Act. And there's a do not pay system. And I use annoying quotes for the do not pay system because it sounds like it's just one system. It's actually a combination of different ways and different databases that payments can be bounced off of before a payment goes out. And one of them is the Social Security system. Social Security purchases all death information from the counties. And then through Social Security system, any federal agency, in this case, it was Treasury that was making these payments for the COVID, any department in the federal government, in this case, Treasury, can bounce their payments against those county death records that Social Security Administration purchased for the federal government, can bounce their payments off of those before they make the payments. For whatever reason, they didn't do this in this case. I think they got so tangled up in trying to figure out the fastest way to get the payments out there that they skipped that step and ended up making payments to deceased individuals. I guess that's the reason. I didn't read the report. You're going to read it, and you're going to summarize it for me and talk about what was the control weakness that allowed those payments to go out. So I got to put something up for that. I'll be doing that here in the next few days so that you can get going on that. Don't kill yourself on that. It's just a matter of going through that report, looking to see what some of the causes were for that problem, and then writing me something up for that. Okay. Any question on that? I'll try to get that out in the next couple of days, guys, because I know we're halfway through the semester, so it's about time we got on that. Okay, good. So again, this table. So the sample indicates that the population is okay, and it is okay. God tells us, yes, my children, the population really was okay. That's a correct decision. Okay. Sample indicates the population is okay when the true condition of the population is that it's not okay. And I'm down in table B here now for controls. We have what? Now we have suffered the risk of assessing control risk too low. Our audit is not going to be effective. Okay. Now, sample indicates that the population is not okay. It's really not okay. That's a correct decision. Sample indicates the population is not okay when it is okay. That's the risk of assessing control risk too high. Our audit is not going to be efficient. Did I say efficient before for the other one? Risk of assessing controls too low. The audit is not effective. Risk of assessing control risk too high, the audit is not going to be efficient. Okay. Okay, go up to the substantive testing. Sample case population is okay. It is okay. That's a correct decision. Sample case population is okay when it's not okay. That's the risk of incorrect acceptance. The audit is not effective. Okay. Sample case of population is not okay. It's really not okay. That's a correct decision. Sample case of population is not okay when it is okay. That's the risk of incorrect rejection. The audit is not efficient. So really, you know, those last couple of slides, and I think I put stars on those on the last couple. Okay, I did put stars on those, but really the whole thing is summarized, or how you should understand that it's summarized right here. Question?
I have a question regarding the project that we just given out.
Yeah.
Oh, and it's individual project.
Yeah, I don't think that it's terribly complicated. You need to break it up at all. Yeah, I'd like to hear from each one of you.
Okay, thank you.
Most likely, what I'll ask you to do, I'll create an assignment in e-learning And
Yes.
what I'll do is I'll just ask you to submit the assignment in e-learning. I'll have you be able to upload a file. So if you can upload a Word file or something, couple pages, I think you might need. It shouldn't take you, I have to come up with a time that it'll take you, I'd say maybe 2-3 hours. Okay, so I don't really see that it's necessary to split it up. It gives me a chance to hear from all you on a one-by-one basis.
Thank you.
Professor, I have a question.
Yeah.
So can you explain the part that both of, in each test, both of them that it's not okay, not okay? Can you explain that again? I just want to know why we end up to the correct decision.
Well, if it's not okay, well, if it says not okay here and not okay here, that's a correct decision. Okay. In other words, the sample indicates that the population is not okay, and it's really not okay. Then our conclusion based on the sample is that there was a material misstatement in the account balance, and we're going to say give a modified opinion. Maybe we're going to qualify our opinion, give an adverse opinion. So we made the right decision, didn't we?
Oh, right. Okay.
Okay.
Yeah.
Okay. Yeah, the table gets a little song singy, but I think once you look at it a couple of times, you can see it's a pretty good tool for you to remember how to handle these different situations on some of the questions. We'll see how some of these look on some of these questions in a couple of minutes. Okay, good. Okay, we're going to see different factors will affect sample size. Don't worry, guys, we're going to get more into this on the next slide. And I don't even know why this 3 is down here. Note to self, I could probably get rid of this slide, but we'll see how these different factors affect sample size. Okay, now we're going to have something called confidence level. Okay, confidence level tells you how confident you are in your conclusion. Okay, so what happens? If we are sitting here and we're at the 95% confidence level, that means we're 95% sure we have come to the correct conclusion. Okay, now if we are 99% confidence level, that means we're 99% sure that we are correct. That means that what? There's a 5% chance, now going back here, the 95% confidence level, there's a 5% chance that we are what? That we're wrong. Okay, if we're at the 99% confidence level, that means there's a 1% chance that we are wrong. Okay, how do you feel about that? How do you feel about there being a 5% chance, a 1% chance that we're wrong? That's a question. Reach out with your feelings, Luke. Andy, you look like you're ready to answer that. We can't hear you though.
Can you hear me now?
Yeah, I can hear you now.
I said it's normal to have like percent that you're gonna be wrong because no one's always right.
Yeah, that's a good way of putting it. No one's always right. There's always a chance that you could be wrong, right? Correct? Okay, good. So where do you want to be? Do you want to be 99% correct or 95% correct?
99.
Yeah, me too. Unfortunately, 99% costs more than 95%. Okay, in order to be 99% sure versus 95% sure versus 90% sure, there's going to be costs associated with that. Because in order to be what, 99% sure, let's say for my substantive testing, what am I going to do? I'm probably going to have to use external evidence instead of internal evidence, larger sample sizes. I'm going to probably have to do my testing at year end, which is going to be more costly to me. Okay, so it really is a trade-off between the auditor's aversion to risk. Looks like this guy over here, you know, walking on this tightrope, carrying all this stuff. You know, he's probably more of a risk taker. Whereas if you're someone that drives a, you know, brown Volvo, you're probably someone that's going to be a little more risk adverse and look for that 99%. So it's really has to do with the person's risk aversion as to how you start to fall into where you're going to go with these. Sometimes the firm will have a requirement. For example, in my office, the GAO, we always had to set our samples so that we could be at the 95% confidence level, which is pretty high. I mean, some entities would go at 90%, et cetera. So it really just depends on a lot of things. The auditor's own personal risk aversion could depend on the policy of the firm. Okay. Okay, good. Now you come over and you take a look at the different types of audit sampling, and both statistical and non-statistical are acceptable under the standards. Be careful, guys, because you'll see questions in your homework that will say, you know, try to trick you into that you have to use statistical sampling. You do not. You could still look at 100%, less than 100% of the transactions, and use a non-statistical measure, haphazard sampling. I'm just going to reach in and pull out the first 10 transactions that come out of the system or something. That would be non-statistical sampling. That would be considered haphazard sampling. That's going to be, you know, something that you're probably not going to be able to quantify your conclusions. Okay, whereas with statistical sampling, the auditor will be able to say, I'm 95% confident that the true range of the population does not exceed this range or something. So you're very specific about your conclusions in terms of, you're never 100% sure that you got it right, because no one's always right, but what you can at least quantify the extent to which there's a chance that maybe you haven't made the correct conclusion. Okay, so to get those confidence levels and whatnot, you're going to have to use sampling, but you don't have to. The standards do not, you're going to have to use statistical sampling, but the standards do not require that you use statistical sampling. You could use non-statistical. And then again, nothing replaces auditor judgment. Don't fall for that one. There's a few questions in the homework. I'll have some question on the quiz. Will say, the auditor can use sampling to replace auditor judgment. No, that's always wrong. Okay, so let's just take a look at a couple questions from the homework here. An advantage of statistical sampling over non-statistical, it allows us to measure the sufficiency of the evidence matter we obtain. We can say we are 99% sure, we're 95% sure, okay? It does not reduce audit risk and materiality to a relatively low level. You know, sometimes students say, well, why not? And my answer is because that's dumb, because it doesn't, okay? It might, through sampling, be able to get our confidence level. The larger the sample, the lower the confidence level. But why would it affect our materiality? So materiality really is what makes this wrong. Remember, materiality says what? What's the maximum amount of misstatement we'll accept in this account balance without determining if the financial statements are not materially misstating. And we had both a performance materiality and an overall financial statement materiality. Okay, minimize the failure to detect error and fraud. I don't see that statistical versus non-statistical will minimize the failure to detect the fraud. You know, we could use statistical sampling and then pick the world's worst audit procedures for that sample, and now we've suffered what? Non-sampling risks that didn't allow us to detect fraud. Conversely, we could use non-statistical sampling and use a very good audit procedure and maybe come to a better conclusion and actually detect error and fraud. So again, it's more, what is it? How does it allow us to quantify what our conclusions are? Eliminate the risk of non-sampling errors. Well, that's nonsense. Any kind of sampling is not going to eliminate non-sampling errors. So Sometimes I like to read these other ones just to give me a couple laughs, okay? Which of the following best illustrates the concept of sampling risk? And you can see the answer is what? A random sample chosen may not be representative of the population. That's the problem with the sampling, right? What happens? I sit there and let's say I have a barrel full of apples and I want to determine if there's any of them that are poison, okay? Well, what would happen? Sampling risk is the risk that I'll pull a sample of 10 apples and what? I'll test all 10 of them, they'll come back, no poison, and then I reach in the barrel, I put those apples back in, I reach in the barrel and I grab one that is poison, right? That's your sampling risk, and of course. In that case, you wouldn't want to use sampling, you'd want to use 100% testing, right? Okay. Okay, sample to test controls are intended to provide a basis for an auditor to conclude whether the controls have operating effectiveness. Let's think about internal controls again. Okay, our control risk, what do? We obtain an understanding of the controls sufficient to evaluate the design of the controls and determine if they have been implemented, right? We're probably using some inquiry, some observation for that. We're doing a walkthrough of the transactions. Then what? Then we're going to go ahead and determine that control has operating effectiveness. So what are we going to do? Now we're going to do some inspection of documents. We're going to do some reperformance. Now we're not going to inspect every single transaction. We're not going to reperform every single transaction. So what do? We pull a sample of transactions to see if that control has operating effectiveness. So going back to our jewelry shop, I think I said we would pull 49 more days of transactions to look to see that the inventory sheets were signed off on, whatever it was. That was an example of using sampling to test what? The operating effectiveness of the control. Now remember, again, that's only if we believe that the control had a good design and or was implemented, right? If we don't like the design and or the control is not implemented, then we're not going to test the operating effectiveness of the controls. We're going to do what? We'll bypass sampling any controls to look at the any transaction to look at the control has operating effectiveness, and we'll do what? We'll go directly to our substantive testing. And yes, we may use sampling probably for our substantive testing, but when we're testing controls, we're going to use sampling, and we're going to use sampling to test the operating effectiveness. Okay, the likelihood of assessing control risk too high is the risk that the sample selected to test controls does not support the auditor's planned assess level control risk when the true operating effectiveness of the control justifies such an assessment. So what does that mean in English? Okay, what happens? Based on our obtaining understanding, we looked at the design like it. We looked at see if it was implemented, liked it. We said, hey, we think we can support a low control risk. So what do? We pulled the 100 time cards and we looked at the 100 time cards and we saw that there was 30 of them that weren't signed by the supervisor. We said the control does not have operating effectiveness. But if only we had looked at what? All 9,900 more, the entire 10,000, we would have seen that the control did have operating effectiveness. So what do? We assessed control risk too high because the sample indicated that the population didn't, that the control did not have operating effectiveness, that was the condition of population, when in fact the control did have operating effectiveness. So the likelihood of assessing control risk too high is the risk that the sample selected to test controls does not support a planned assess level control risk, say low, when the true operating effectiveness, if I had only kept looking at all the rest of those time cards, I would have found, hey, this supervisor is almost perfect. We were just unlucky. We so happened to pick the 20 times that we didn't sign it. All the remaining 9,900 were all signed perfectly. So there was only 20 times out of 10,000 this control could have been assessed at less than the maximum. We sampled the risk of assessing control was too high based on a sample. Our audit is not going to be what? It's not going to be efficient. I didn't know this question didn't ask that. The risk of incorrect acceptance and the risk of over-reliance. Okay, over-reliance That says over reliance, that's an A. Okay, over reliance means that we assess control risk too low. Under reliance means that we assess control risk too high. Okay, so make a note of that somewhere, because you do see some questions that don't use the terminology assess control risk too high, too low. Instead, they use the phrase here, over reliance, under reliance. Okay, so over reliance, that's what this says. Try it again. I don't know, that doesn't even look like over, that doesn't even look right to me. Okay, so over reliance. Okay, a little better, not much, but a little better. I'm trouble with my A's today. Okay, over reliance means that we have what? Assessed control risk too low. We've over relied on that control. We set our control risk at minimum when in fact control risk should have been high. We over relied on control because why? Now the timing the nature extended timing of my audit procedure is not going to be sufficient for the amount of control risk that's in the true population, right? Under reliance, I assess control risk too high. I had a operating effectiveness there that I could have relied on that control and set my nature extended time on substantive procedures accordingly. My audit is not going to be efficient if I have under rely. But if I over rely and I have the risk of incorrect acceptance, which means I determine the financial statements were not materially misstated when in fact they were, that's not an effective audit. Okay, so at this point, and we had a couple more questions, but I think I want to pause right there and get you sense. I think you're getting the feeling here, even though the language is a little bit complicated. Really, we haven't sat here and we had those 95% confidence levels versus 5% chance of being wrong. But other than that, I haven't seen any numbers in this discussion. It has been what? It has been purely a discussion of definitions that you're going to have to get used to. And if you look, really that sort of one slide that I had up there is really going to help you to answer these questions that get a little more tricky, I think, the one with the table. Okay. Okay, good. Let's take a look at this one. While performing a substantive test of details during an audit. Okay, now when we say substantive test of details, remember that if this is our substantive testing, okay, if this thing represents my substantive test, there'll be a test of details. Classic example, test of details is what? Confirm accounts receivable, right? Would be a test of details. But then, and guys, I'm limited, so blank is going to have to represent my analytical procedures. And remember, we said we may use our analytical procedures. That's not the month of May. That's saying we don't have to. We may use our analytical procedures as a substantive test, right? So we can do a combination of test of details and analytical procedures. Remember, we said that analytical procedures, you probably don't use a sample for that. You compare last year's account receivable balance to this year's account receivable balance. You use the number of new customers versus last year's number of customers. I don't know, but you're not going to use a sample for that, right? Whereas when you send out a confirmation, if your client has 10,000 customers, trust me, you are not going to send out 10,000 confirmations to those individuals. So what are you going to do? You're probably going to sit there, pull a sample of those items, and then go ahead and send out your confirmation to the sample of those 10,000, 100 confirmations, whatever. So you would use what? Sampling for your test of details, okay? So while performing a substantive test of details, that's what that's talking about. Maybe you sent out some confirmation, you use a substantive test of details. Okay, the auditor determined that sample results support the conclusion that the recorded account balance was materially misstated. It in fact was not materially misstated. That's almost right off the time card. That's right off of that one flashcard type item I showed you. We have what? We have suffered the risk of incorrect rejection. Our audit is not going to be what? It's not going to be efficient, and that will probably end up coming to the correct answer when we expand our sample size, et cetera, and try to get to the bottom of this. Okay. Okay, good. An underlying feature of random-based selection of item is that each item in the population should have an opportunity to be selected. Okay, now, I'm not sure that we mentioned this. It was probably on one of those slides, but I forgot to call it out. Okay, so let me just elaborate here. You are to use random selection in audits. Okay, there are other auditing techniques that can be used that aren't random. For example, using block sampling. Block sampling, really works if you're doing the census. That's why they call it block sampling, because you sit there and you try to get a representation of a particular area of a demographic or something, of a particular zip code. That's considered block sampling. They literally call it block sampling because you have city blocks that you would do the sampling. For something like the census or something, block sampling might be okay. For audit, we use random sampling. For audit, we use random sampling, okay? Just always remember that. Random means that every transaction account balance has an equal chance of being selected. That's random. Let me see. Look, here's this one, stratum. Okay, what the heck is stratum? Okay, remember I said we could stratify the sample. So when we stratified the sample, we picked those ones off the top, right? We stratified those. So we knew we picked all those. They had as much chance of being picked as any, but we picked them first. And then we did a random sample of the remaining 95. So those remaining 95, that was random sampling because the remaining 95 all had an equal chance of being selected. So we call that random. Okay. Okay, so that's some of our basic stuff here. Before we jump into this attribute sampling discussion, any question about anything we talked about so far, which is really a definitional thing? Okay, so this is going to be chapter 8 right here. Okay, I'm going to try to finish that before the break. This is going to be chapter 9. Goal is to finish that tonight too. Okay, so we're going to try to get through chapter 8 and 9. Yeah, I'm just going to say that. I want to get to chapter 8 and 9 tonight. Okay, good. So let's take a look at attribute sampling again, as I wrote on the previous slide. Forgot to point it out, but I wrote on the previous slide there. We use attribute sampling for test of controls. So we're looking to see if a transaction contains the attribute of what? Supervisor's signature on the time card is an attribute. You have blonde hair, that's an attribute. You have black hair, that's an attribute. You have no hair, that's an attribute. What is unique about that particular transaction, or what does it contain a certain attribute that we're looking for? Sales invoice. Before a sale is authorized, before a credit sale is authorized, there has to be a credit approval. There has to have been a credit check on that. There have to have been a credit authorized on that for that individual before we let them open up a sales account on the credit. Okay, so these are the kinds of things that you would look for on a transaction. Does it contain this control? We call that attribute sampling. So attribute sampling is used for controls. Okay. Now we'll also use monetary unit sampling, and we'll look at that in chapter 9 some more when we get into a discussion of our substantive testing. And classical variables is used for substantive testing also. We'll get into that in chapter 9 as well. Okay, so we're not going to say much more about those until we get to chapter 9, the monetary unit sampling and the classic variables. Now, you look at this question, and it says, for which of the following would we use attribute sampling? And we look for the one that what would be talking about a control. So you look at these other three, the wrong answers, the amount of inventory, valuation of fixed balances, accounts receivable balance confirmation, those are what? Those are describing substantive tests to you. We use attribute sampling for what? For control tests, and we've been using this example now for most of the evening here, the what? The inspection of time card for supervisor approval. Yeah, that is where you'll use attribute sampling for a control test, because the supervisor's signature is a control procedure. Okay, so we have these different steps, guys, and what we're going to do is we're going to give you some definitional things here in the next couple of slides, and then we're literally going to walk through an example, and we're going to see how we would do these different steps: the plan, perform, evaluate, documentation. Okay, but before we do that, we need to get some definitions down. Okay, now, as I wrote across the top here, these factors affect sample size, and you have to know how these factors affect sample size. I'm going to put some of them scary looking stars on here. This is important. You must know how these different factors affect sample size for your control testing in an attribute sample. Okay, so assessing control risk too low. Okay, and you can see this discussion down here. There's an inverse relationship to sample size. The auditor is willing to accept greater risk. You can have a smaller sample size, or if you want to reduce the risk, you're going to have what? A bigger sample size. So it is an inverse relationship. Okay, so what happens? Let's say I want to be at the 95% confidence level. That means I'm only willing to accept a 5% chance that I'm wrong. So you think, let's just use that example of the apples again. So I tell you, a barrel of apples, 100 apples, there's a chance that some of them are poison. So I sit here and I do what? I pull out the 10 of the apples and I test them. I have a little machine over here that the light turns green if the apples aren't poison, red if they are poison. The alarms go off and everything. I test the 10 apples, ding, everything's fine. Green light for all 10 of the apples, they're fine. I put them back in the barrel, I mix them up, and I say, there's a chance that some of them could be poison, but the sample said they're not poison. Andy, would you like to try an apple?
Yeah, why not?
Well, I'll tell you why not. It's not the Sleeping Beauty poison. Okay, it's the poison from that movie, The Rock. You know, your skin melts off and you go all this, and then your back breaks at the end. Okay, so it's the horrible death. Okay, so what happens? If I sit there and I test 10 of the apples, put them back, nothing comes back poison, right? Put them back in the barrel. I told you there is a chance. The sample indicates no. But I don't know, maybe it's because I hail from the dark side. I'm born and raised in Hayward. You know, we always think something's wrong. Okay, so I'm sitting here thinking, well, I don't give a damn if the population, the sample told you the population is okay. If you're telling me I'm gonna suffer this horrible death by eating a poison apple, brother, you better test all 100 of them before I'm gonna eat one of those apples, right? And so now I see you shaking your head again. So you're instinctively now feeling sampling risk, right? And if I want to lower that sampling risk, well, in this case, no sample size would be good enough for you. You'd say, hell no, test all 100 apples. So no you know, so there is no sample size. You got to test all 100 apples, right? But let's say it wasn't quite as ominous. Okay, you weren't going to have all that horrible experience, you know. Then you might say, okay, John, I'm not too comfortable with 10 apples, but get me to the 99% confidence level. I'm going to say, okay, well, to do that, I got to do what? I got to test more apples, right? Okay, so what happens? The lower you want to get that risk of assessing control risk too low, okay, meaning if you want to get your risk of assessing control risk too low from 5% to say 1%, then you're going to have to do what? You're going to have to increase your sample size, right? If you sit there and say, oh, I'm willing to take a little more risk, I'll take a 5% risk of assessing control risk too low. Well, now I've come down in my what? Excuse me, I've come up in my risk. I've gone from 1% in that example I just gave you. I've gone from 1% in that example I just gave you to 5%. So I've gone up in my risk of assessing control risk too low. I've gone from what? I've gone from 1% to 5%. Now I can have a smaller sample size. If I want to do what? If I want to go from 5% to 1%, now I need what? A bigger sample size. And if I want to get this risk of assessing control risk too low down to 0, then I'm going to have to do what? No sample. I'm going to have to look at all the items, right? Question on that? Okay, good. Let's look at tolerable deviation rate. And we say there is an inverse relationship to sample size. As the auditor is willing to accept a greater deviation rate, a smaller sample size can be used. Okay, now that one gets a little bit more difficult to feel intuitively. Okay, so let's just think about this. Tolerable deviation rate is the maximum amount of deviation I will accept from a control procedure and still determine the control has operating effectiveness. Okay, so if my tolerable, let's say I have 100 items and I'm willing to accept 3 times out of 100 that the supervisor didn't sign the time card, that means my tolerable deviation rate is what? 3%. If I'm willing to accept, say, 4 times that the supervisor didn't accept the time card, didn't sign the time card, then my tolerable deviation rate is 4%. Now, at this point in time, how many time cards has the auditor looked at? $100. Okay, thank you for trying. Okay, thank you for playing. Okay, but no, at this point, Andy, I haven't looked at any. I am basing this based on how important I think the control is. Okay, and so what they're saying to you is if you're trying to get what? You're trying to get that tolerable deviation rate down, that tolerable deviation rate is smaller, then you must think that control is pretty important, right? So the smaller the tolerable deviation rate, you're saying, you know what? I'm only willing to accept 1 time that this supervisor didn't sign the time card because I really think this is important control. If that's the case, then what? You're going to have to look at a larger sample size because you believe that's a very important control. Whereas if you're sitting there saying, oh, okay, you know, I can accept a few times the supervisor didn't sign the time card, that means that you think that that control what is not as critical, so you don't have to look at as many items. In fact, let's say you don't think the control is important at all. Let's say you think the control is ineffective. How many items would you look at for your control test? None. Beautiful. You don't look at any. If you sat there and you said, this control, who cares? In fact, this control is ineffective. I don't care if they ever did this. Then what? Then you don't look at any items, right? So the lower you're trying to assess your control risk, remember I said last time, you have to get more better evidence. If you're trying to get that control risk down lower, you're going to have to look at what? More items for your control testing and what? Have more reperformance and less inquiry. Okay, so your tolerable deviation rate, I can tolerate this person not signing this, deviating from this control quite a bit. That's the same as saying, I don't think this control is as important. higher tolerable deviation rate, smaller sample size, lower tolerable deviation rate, larger sample size, inverse relationship. And just to sort of put a visual in front of you here, I just sort of wrote up this slide. And guys, I put this in here with the extreme caution that you do not say, well, my teacher, Professor Lord, whatever you call me, John told me that if I have a low assessment of control risk, that means that my tolerable deviation rate needs to be between 0 and 3%. You get in a fight over it or something. Okay, there's nothing in standard that says this. I'm giving you examples, some things that I've got this bookcase behind me. You know, I've got all these. You know, little did I know when I was, 17, that my bookcase would end up being filled with, books about accounting and auditing, right? But so I've got some books back here that I probably pulled one of these things from that gave this as an example. So this is not standard, but this might be a way of looking at this. So what happens? You have what? You have assessed your control risk at low. Okay, now how did you assess your control risk at low? Well, you like the design and you like the implementation. And so now you're saying, this is a very critical control. If this control works, that means that there's a good chance that they have prevented or detected a misstatement. So I really, please God, let this control work, because this is a really good control. So what happens? You're saying your tolerable deviation rate is 0 to 3%. I want to see that this control work every time, because I'm going to base my life on this. I'm going to say that if this control works, there's not a misstatement. So what's going to happen? I think you're instinctively feeling, well, then I better look at a lot of transactions to see that that control really, really did work. I don't want a small sample. I want a big sample, so I can look at a lot of transactions to see that that control was there. So if I'm having a lower assessed low control risk, that means my tolerable deviation rate is probably in a fairly low range. Tolerable deviation rate is lower. What happens? Sample size is going to be larger, inverse relationship. If I'm in the moderate, okay, it's an important control, but I'm not going to hang my whole life on this. Then what? Maybe your tolerable deviation rate is in the 4 to 7%. Tolerable deviation rate's gone up. My sample size from my control test has come down. If I assess control risk at maximum, and again, these percentages, guys, are just sort of examples, meaning you're sitting there saying, I think that this control is not very effective, and there's going to be a high rate of occurrence where the control is not going to be applied, is not going to have operating effectiveness. I'm not going to look at this thing. And so you go ahead and bypass the control testing. Now that means what? The sample sizes and whatnot for your substantive testing, nature, extended timing, are going to come up, right, to lower your detection risk. Okay. Okay, there were a couple more on this slide that I wanted to show you. Expected deviation rate. What happens here? We say that there is a direct relationship to sample size. So what happens? I have a client, let's say, that messes up the control every year. Every year I come in, they don't sign those time cards, man. Every time I look at this, they don't sign the time cards, right? What happens? I come in and they tell me, guess what, auditor? Guess what? This year, we got it. We signed the time cards. We know you yell at us every year. By the way, don't ever yell at a client, okay? You yell at us every year and we mess this up. Please, we got it right this year. So what are you going to do? You're going to say, oh, really? So now what? Well, my expectation doesn't change based on what they say to me. So I'm still going to have a pretty large sample size because I want to see, did they really do this, right? So I look and I see, okay, my expected deviation rate was based on my past experience. They usually don't do this. This year, they're telling me they are doing it. And so I'm going to give them the benefit of the doubt. I'm going to go ahead and sample some items and look. I'm going to look at a lot of items to see that they're really doing it, right? Year 2, I walk in, and they don't even say anything to me. It's, part of their DNA now. Well, I might even keep that sample size large in year 2. Again, in year 2, they do a good job. Now I'm thinking, okay, they really got it. So what happens? In year 3, the standards would allow me to what? Bring that expected deviation rate down And now I could use a smaller sample size based on my experience from previous audits. Okay, so I could use experience from previous audits to determine what that sample size would be for this particular test, because my expectation is that I have a pretty good, pretty clean client. Now, sometimes I'll get the question from students, well, what if you never audited them before? Well, what I may do is take a small preliminary sample, see how well they've done with that control, and based on that smaller preliminary sample, I might then go ahead and set my expected deviation rate. Again, if I see a lot of deviation, my expected deviation rate is going up, my sample size is going up. If I don't see a lot of deviation from that, maybe I can justify a smaller sample size. So that works with it as a direct relationship. For our attribute sampling, not for our substantive testing, but for our control testing, population size has a relatively negligible effect on sample size. Okay, attribute samples, population size has a negligible effect, really does not affect sample size for fairly large populations, those greater than 5,000. Okay, question on this. You got to know this, okay, the way these different things affect sample size. All right, so let's just go ahead and let's take a look at this example, okay? And in this example, we have a desired confidence level of 95%. Again, this is translates into a 5% risk of assessing control risk too low. So you take 1 minus 5%, that's how you get the 95%. Okay, so 5% risk of assessing control risk too low equals the 95% confidence level. Okay, tolerable deviation rate is 6%, expected deviation is 1%, and they want us to determine the sample size. Okay, if I told you that we were at the 99% desired confidence level, what would be our risk of assessing control risk too low? Good, 1%, right? Okay, good. Okay, so that's how that works. So they complement each other. Okay, so we're going to see how these parameters affect sample size. Now, the table that they're going to show us an excerpt from comes directly from the, it was SAS 39. Guys, I'm going to draw a blank on where in the standards it is. It's AUC something or another. I forget what part of AUC it is. Okay. See what a nerd I am. Okay, I'm gonna go ahead now and I'm gonna have to look it up. Maybe I'm not gonna be able to see it. Anyone see it? It's I'm trying to see what section, what AUC section it is, the audit sampling. Okay, ever since they moved these around, I used to have them memorized as to where a particular SAS fell. Remember, SASs is how they fall chronologically. Okay, and then the AUC section is how they're codified. Seems like it should be somewhere under evidence, though. Okay, I don't know. Nobody see it? Okay. Anyway, it's in there somewhere. Something makes me want to say that it is in 300 somewhere. Oh, well, stop, John. Anyway, it's in one of the AUC sections, okay? But it's SAS, because SAS indicates how they came up chronologically. So it's SAS 39, okay? And this table is right in the, it's actually not in SAS 39, it's in the audit sampling guides. So AICPA issues the standards, but then they also issue guides. Okay, and so these tables that we're going to be using to determine sample size come right out of the that audit sampling guide, which is based on SAS 39. That's somewhere in the codification there. Okay, so remember we were at the 95% confidence level. Okay, 95% confidence level. That means 5% risk of assessing control risk too low. I kind of wrote that over here. Okay, and I come over and I want to see what the sample size is. So I go to the expected deviation rate. And again, we're leveraging off of the information from this previous slide. So the expected deviation rate was 1%. So if you have a 1% expected deviation rate, and then you slide over and it was what? 6% tolerable deviation rate. This table is telling me that for this particular control test that I'm going to do, looking to see, and in this case, what we are assuming in this example is we're looking for a sales order that does not have credit approval. So if this is the sales order, okay, we're going to do a control test that's going to look to see if we can see the approval. We're looking for that star down there. Is there approval on this sales order? That's what we're looking for here. Okay. And so we sit here and we're really looking for for some that are missing the sales order. It's kind of hard to draw a picture of something that's not there. We're looking for ones that might be missing the sales order. Okay. So we're going to pull a sample, and for these factors, for desired confidence level of 95% or translated into assessing control risk too low at 5%, we're going to have tolerable deviation rate of 6% in this one, expected population rate 1%. And so what's the sample size? And this table is saying for that test, your sample size should be 78 items. You should look at 78 items to see if there was that credit approval. Okay. Notice that the population really is not going to affect sample size here. Okay. Question? Okay, good. Let's take a look at this one. And now they're going to ask us to play with this table a little bit in this exercise. So would sample size increase or decrease if the expected deviation rate decreased to 0%? Remember, we said it's a what? Direct relationship. If my sense with this client is that they're pretty good, they don't make a lot of mistakes based on previous audits or whatever, my expected deviation rate goes to 0%. The table's telling me, since you have previous experience, nothing replaces auditor judgment. Since you have previous experience with this client, that will affect your sample size here. You don't have to look at as many items, assuming this client was pretty good, right? If my expectation client is not as good, then the sample size is going to increase. Direct relationship. Smaller expected deviation rate, smaller sample size. Okay. Then we come over and we look at this next one. And would sample size increase or decrease if tolerable deviation rate increased from the 6% to the 7%? Okay, so let's just look at the table. And you can see that sample size now would go from the 78 down to 66. Why? If I've increased my tolerable deviation rate, that's in effect telling you, this control is not as important as some other controls. So I'm not going to look at as many items. Now, again, guys, you're sitting there saying, well, hell, John, 7%. I think your table, was already saying you're heading towards 0 here. Well, remember, I just kind of put some numbers that I've seen talked about. It is not written standard as to what number gets you to a point where you're not going to be testing the controls. Okay, but what tolerable deviation rate? So you may see tables that have tolerable deviation rates that go up quite a bit. I think the literature that I was looking at was indicating to you when you start feeling that you're going to accept a control that doesn't work, 10% of the time, you probably should give up on that control. Okay, but anyway, again, the standards don't say that. Okay, so you take a look and inverse relationship is tolerable deviation rate comes up, sample size goes down. Okay, now just completing this exercise here. Would sample size increase or decrease if the risk of assessing control risk too low increase to 10%? Now, I can't go back to this table to verify, okay, but what I can tell you is if your risk of assessing control risk too low went from 5% to 10%, you're willing to take more risk. Inverse relationship, and I can tell you that on the 90% confidence level table, all the numbers are smaller. All the numbers are smaller on that table. I can't show you on this table. I'm just telling you, all the numbers are smaller because what am I doing? I'm accepting more risk. Okay. So again, key slide here, and then the slides that come after that give you some numerical example to see how that would go through. Question? Okay, good. So what I'm going to do right here before you go into a coma is take a break. So I think we understand how the table works. And I'm going to build up a little mystery here. I'm going to say, when we come back from our break, we're going to see now what will happen is we actually test these sales invoices to see if they have the credit approval. But you can't wait, right? Okay, so let's just go ahead. Let's do a 10-minute break. Let's just, for round numbers, say make it 7:20, okay? And we'll pick up here with the exercise that we just were looking at. Okay, guys, I want to go ahead and get started. I know we'll get through chapter 8. I'm starting to have some doubts about chapter 9, but let's just see how we proceed here. So I want us to jump in. So again, remember we saw how sample size is affected by these various factors. I'll go back again to what we were using in this example, which was our, let's go back to this one, it's a little easier to see. Okay, our desired confidence level, tolerable deviation rate, expected deviation rate, and we came up with the sample size using those in this particular example of 78. Okay, again, it's important that you know how these different factors affect sample size, but once we determine that our sample size is 78, then we go ahead and we look to see, and again, in this example, we were looking to see to what extent these sales invoices had a credit approval on them. Now, let me ask you a question. I probably should ask you this already. Why are we interested in seeing if a sales order had a credit approval? Why do we care?
Because if it didn't, it could be a fake sales order used to boost revenue.
Okay. Down, yeah, I'm looking.
Or it could be the wrong or it could be credit approval given to a customer that shouldn't have received it because they haven't paid, they're not good on their credit, or it has exceeded their credit limit.
Yeah, they don't have a good credit rating, right? I mean, I don't know about you, you guys probably never experienced this. There's nothing more humiliating than you go to the store and they say, oh, would you like to open up an instant credit account today? And you say, yeah, okay, yeah, sure. Yeah, oh yeah, that sounds great. I don't have to pay for 90 days. Okay. And then they run in, oh, they denied you. And you're like, hey, what'd you ask me for? I mean, you just ruined my day, right? Okay. But there's nothing better than when they go and they make the separate call and then all of a sudden, oh, it came through. In fact, they approved you for that much more. Oh, let me buy some more junk I don't need, right? Okay. So what happens? That is a separation of duty. The salesperson probably could care less if you can pay. But remember, we separate the authorization from the recording of the transaction or the custody of these assets. I mean, think about it. When you take somebody's product that they produce and you don't pay them until later, I don't care, who you are, that's a scary proposition. You may never see, how long does it take me to design this robot? Now I'm going to let you take it and I'm not going to get any money for it until later based on your promise to pay, right? So how can I make sure or get some feeling? I can never make sure, but how can I get some feeling that maybe you'll pay me? I know I'll have a separate person over here who sits in a separate office somewhere, look to see that you have the good credit approval so that if you do, I've just increased the company's chances of collecting on that receivable, right? Okay. But why doesn't that's why the company wants there to be credit approval. Why does the auditor care if the company got the credit approval? What's it to the auditor? We understand why the company wants the credit approval. They want to get paid for their robot. So they look at your history and say, okay, this person's a good credit risk. So let's go ahead and take the robot and we're pretty sure they'll pay because they have a high credit rating.
Is it the reason you mentioned about it's proof that or evidence that the segregation of duties exists and is being carried or followed through with?
Well, we would want to see that there is separation of that duty, okay? And we'd want to see, so we would want to, that probably be more the design, Davi, that's a separate person. So the design part would be separate person from the person that makes the sale, checks the credit, okay, and the transaction doesn't go through until that separate person does it. That's probably a good design. But we not only look at design, we also look at what?
Implementation.
Okay, so we want to look at implementation. So maybe we're there one day and we see them going through this process. We see it's implemented. So we think we can assess the risk of material misstatement at less than the maximum. Now we're into the testing of the operating effectiveness, aren't we? So we're taking a sample of transactions, invoices, and looking for the credit approval, right? But why is the auditor sitting there looking to see that that control has operating effectiveness?
Is it so that like the allowance for doubtful accounts is more credible because we've looked at whether or not people can pay?
Okay, good, excellent. So what's happened here? I've got what? I've got a control risk that has come down, right? And I've got a control risk that's come down. So now my detection risk can go up, right? Because my control risk is lower, my detection risk can go up. Okay. So when I'm designing my audit procedure, maybe I'm going to do what? I'm going to do an analytical procedure. I don't have to do as much test of details here. I can do what? Nature an audit procedure that is not as effective an analytical procedure because I've got a good control in place there, right? So I did this what? I did this control testing to lower my risk of material misstatement so that my detection risk can come up a little bit. So now I'm doing a different substantive procedure. That's the logic, right? What account are we talking about here? What account? Remember this whole process we're going through. Think about what we've done, guys. We sit here, we have an account. What's the next thing on that table, that sales table that we had the other day? Assertion. So all of this we're doing, lining it up along what? Along with an account balance, an assertion. Think of a potential misstatement. Potential misstatement is what? Well, if I tell you the potential misstatement, I'm telling you the account. What account?
Is it sales or income?
Well, we have the sale. I mean, the person took the stuff, we sold it to them.
Oh, accounts receivable, sorry.
Okay, well, accounts receivable, yes. What assertion?
I'm stumped, I don't know.
That's all right.
Existence.
Well, existence means that the person took the goods and acknowledges they owe us money, right? Person's out there, they're saying they owe us money. We can use a confirmation. The person can come back and say, yes, I owe $25,000, right? So is worrying about credit authorization going to really help us with existence?
Would it be valuation?
Good, thank you. This is going to be what? This is going to be valuation, right? So I'm looking at accounts receivable, but I'm really kind of looking at what? The allowance for doubtful accounts, right? So think about it, guys. What have we accomplished here by doing this control test that we're going to do here? We're going to lower our control risk, if the control works. We're going to lower our control risk. By lowering our control risk, now as we use up our audit resources, we do what? We can use up our audit resources maybe more around the existence assertion to make sure that the account receivable actually exists. And maybe we're going to be using what external evidence for that. Maybe because we have an issue with that particular assertion, maybe we have larger sample sizes for that substantive test. But when it comes down to the valuation assertion for account receivable and the related allowance for doubtful accounts, all we have to do is a quick analytic procedure. Do we think that the amount that's in there is appropriate related to the account balance because we've got this good control of the credit checks, right? Okay, so I just want to put where we are in context of that overall process. We're in that testing control column right now, right? And we're going through the mechanics right now of how do we determine our sample size? Now we've determined our sample size. We've got these 78, and we're going to look at them and we're going to see if they have the credit approval on them. Now, in this particular case, we looked and we found two deviations that did not have the credit approval. Now, when you take 2 and you divide that by 78, that's a 2.6% deviation rate. Now, this is a sample. This is a sample. There's a chance that what? The deviation rate in the population could be higher or it could be lower, right? It's going to be a range. I mean, this is a sample. We found 2 out of 78. It gave us 2.6. Maybe the deviation rate is less than 2.6. Maybe it's more than 2.6. But as auditors, we only look at the one side of that tail, if you will. We're interested on what? How high can this go? Because if the deviation rate goes too high, what are we going to determine? We're going to determine that the control does not have operating effectiveness, and we're going to what? We're going to do the full measure of our substantive testing. So we just look at the upper end of this, the upper deviation rate of 8.2%. Now, if our tolerable deviation rate was 6%, and this test is showing me that the upper deviation rate could be the upper deviation rate could be 8.2%, and the auditor was only willing to tolerate a 6% deviation rate. Is the auditor happy or sad? Those are the eyes. I need you to tell me them now.
Sad.
Huh?
Sad.
Well, sad, right? The auditor is sad because what? He was sitting there saying, she was sitting there saying, hey, I was willing to take up to 6% deviation. This is telling me what? It could be as high as 8.2%. I can't live with that, right? So now what? Now, I mean, maybe the auditor is happy if they have a fetish for substantive testing, because that's what's going to happen now, right? Nature, extent, timing. I'm going to have to use larger sample sizes for my substantive test. Nature, external evidence, extent, larger sample size, timing, year-end testing, right? Okay. Now you come over and you take a look at this table, which is where they got the upper deviation rate. Now, it is important that if you pull the sample size, that 78 came from a 95% confidence level or 5% risk of assessing control is too low. Those are synonymous terms. Then when you evaluate the sample, and this table comes from the audit guide as well. Okay, when you evaluate the sample, you must go to a 95%, 5% risk of assessing control is too low table to evaluate the sample. And you look to the number of deviations you found, you find your sample size, and that intersection is your upper deviation rate. Now remember, we had what? We had only 2 deviations. We only had a 2.6% tolerable deviation, 2.6, deviation rate in the sample, right? Okay, 2 divided by the 78. So we have a difference of 5.6%. That 5.6% is called the allowance for sampling risk. That is giving us a cushion. Because remember, this is a sample. If this was poison apples, we really want to make sure we're thinking, what are the chances that there's a poison apple in there? Being very careful here, okay? So we give ourselves a cushion of 5.6%. That's called the allowance for sampling risk. That's a cushion, just in case, telling the auditor, I know your test told you it's 2.6% based on your sample, but it could be as high as 8.2. We're giving you a cushion that allows for sampling risk of 5.6%. Auditor, can you live with that? And if what? If our, as we saw in the previous slide, our tolerable deviation rate was 6%, the answer is no. If our what? Tolerable deviation rate had been, say, 9%, although we're getting a little close to it there. I'm not sure the auditor is too happy. Oh, you can't see that. The auditor in this case would be what? Would probably be happy right here, okay? Because what? We haven't exceed our tolerable deviation rate. although that's getting a little close. I don't know that I'd be giddy if I was the auditor here, because I'm getting a little close at 9% to 8.2. If it's me, I'm saying, no, okay, I want a more, even though this table is giving me cushion, I don't like how close we're getting to that tolerable deviation rate. But again, auditor judgment, right? But what this table is telling you is, no, go ahead, you're good. If your tolerable deviation rate was 9%. What would you do if your tolerable deviation rate was 9%, was 6%, and you had 8.2%? What would you do?
Would you just increase the sample size?
For what? Increase the sample size for what?
You're testing?
What testing?
I feel like this is a trick question.
I don't know if it's trick. I wouldn't call it a trick question. It is a question though, and it could be tricky. It's the question. Do you want to, what do you, oh, let me ask you this. Do you want to pull more sales orders at this point to see if they're screwed up too?
That's what I meant.
Okay, how do you could do that. Okay, you could do that, but you're gonna have to what? You're gonna have to go back now. And I think now where was I? Now I think your expected deviation rate has gone up. So that's going to determine a new sample size for you. So you'd have to be somewhat scientific about how you do that. But I think your expected deviation rate would go up now. Okay, I think you'd be driving drunk if you change your tolerable deviation rate. Sorry, I think I shouldn't use that term. Never drive drunk. Okay. Drunk driving offense is something that will have you lose your license. Okay, I mean, this is a very serious type of thing, right? And the state of California is not amused if someone gets a DUI. Okay, so it's kind of a big deal, but you're not being as careful as you should be. You're not wearing your seatbelt. Let's put it that way. Okay, because what? You start changing your tolerable deviation rate because your test didn't turn out the way you wanted it to. You're not being very scientific. I wouldn't change your confidence level. Well, what happened? Because your test didn't work. Now let's go, let's leave our mask at home. Okay, no. Now you're sitting there and you're saying, which of these parameters can I change now? I thought the expected deviation rate was 1%. I was wrong. The expected deviation rate now has done what? Has gone up. And so since the expected deviation rate has gone up, and notice what's happening now, Jennifer, my sample size is going up pretty sharply now. I mean, it's not even on this, the table would have on this excerpt of the table, you're not seeing it, but I'm starting to add items pretty quickly, right? Based on a higher expected deviation rate now at 2 something. So you might sit there and say, at this point, I really don't want to be adding, up into the hundreds of sample items that I have to look at. So is there anything else you could do at this point? So the answer to the question, you're increased your sample size for your control testing, you could do that, but I'm starting to get into the realm of, not a very efficient auditor now. Is there something else I could do? The control just worked. The control does not have operating effectiveness. What do you want me to do? If I was at 6% at tolerable deviation rate and I ran this test, right now, this thing's telling me, nope, the control does not have operating effectiveness. What should I do?
You have to lower your detection risk.
Good. Lower my detection risk. Excellent. How do you want me to lower my detection risk?
Increase the level of substantive testing and do your testing at year end and She was the other way.
Nature, extent, timing, good.
Yeah,
Nature, very good. Nature, what? External evidence, extent, larger sample sizes, right? Timing year end, or, and the other thing, and I think that's, hoping that's what's on this next slide, okay? Does not support, that was what that was, right? Oh, okay, it's not there. Hang on. Sorry, guys, my slides are not set up exactly the way that I wanted them to. Is that what this one is saying? Let's see it. No, okay, so I'm just gonna have to say it. Okay, so that's our situation. It does not support reliance on the control, right? Okay, so I'm at a no here. So now, yeah, nature, external evidence, extent, larger sample sizes for my substantive test, timing, year-end testing, right? Or I could look for a control that will compensate for this control. So I was sitting here saying, well, I thought this was the key control. Is there anything else they do that could prevent a detective misstatement? And maybe I just get into it now, another round of testing for a different control, right? But I'm thinking, you know, if I've done my homework properly, I understand something about this entity, I've been around this industry, you know, I understand the client's business operations and whatnot, I probably selected a pretty good control to test. And if I start getting to this point where, hey, this control does not have operating effectiveness, now I'm turning around and I'm doing what? I'm moving to the full measure of my substantive testing, nature, extent, and timing. And if I'm doing a public company, I probably have what? I probably have an internal control weakness that's going to affect my opinion on the internal control. If I'm doing a non-public company, I probably have a control weakness that I'm going to have to report. And I would report that directly to the board of directors. And I would look to see that there's going to be some corrective action, et cetera, right? Okay. Okay, good. Non-statistical sampling, you know, they give us some ideas of sample sizes for non-statistical sampling. I'm probably not going to ask you much about this at all, other than to give you the sense that non-statistical sampling is acceptable, right? Yeah. Okay, again, use random sampling. Okay, let's go ahead and let's take a look at this. Now, I put this question in here because we really didn't talk about the qualitative aspects of deviation. So we kind of were all about the numbers, et cetera, but you'd have to look as to, well, why did the deviation from the control happen? And if it was to conceal a forged document, well, that's going to affect what? Now my inherent risk, my control risk is going up, not just because of errors, but because of what? Fraud. And again, I'm going to have to respond accordingly at the assertion level. So now, because there's fraud potentially involved, I may want to increase my substantive testing, my nature, extent, timing a little more significantly, right? So it's not just quantitative, it's also qualitative factors. Okay. Now for this particular one, I'm looking and I'm looking for a control. Let's say, let's just not even worry about this question. Let's say I was looking for the sales invoices. I pulled my sample of 78 and I asked for sales invoice number 171 because I want to see if it's got the credit approval. And they say, oh, we can't find that one. Well, if I can't find it and I can't look at it, they're not going to say, hey, Charlie, that one had the credit approval on it though, right? Yeah, sure did, Irving. No, if I can't see it, then it's a deviation. So if you have a missing missing item that you're going to look at for the control attribute, and that item is missing, that's a deviation. Okay, so if there's a check missing and you can't inspect that check in this example to see that it had the control attribute, then you treat that as a deviation from your control. Okay, which of the following statements is correct concerning statistical sampling in compliance testing? Okay. You know, compliance testing, control testing are sort of synonymous terms. Compliance testing is a little outdated, but the textbook uses it sometimes. So compliance testing, control testing are synonymous. They really shouldn't use the word compliance testing, because for a government auditor like me, compliance testing is looking at compliance with laws and regulations. Control testing is looking to see that a particular transaction has a control attribute. But in the textbook, sometimes you see them calling it compliance testing. So which of the following statements is true concerning statistical sampling for control testing? The population size has little or no effect. Remember, we said that, right? We had factors that affected the sample size, which was what? Risk of assessing control risk too low, AKA confidence level. We had tolerable deviation rate. We had expected deviation rate. Confidence level or risk of assessing control risk too low and tolerable deviation rate had inverse relationships. Expected sample size had what? I mean, expected deviation rate, excuse me, had what? Had a direct relationship. The other two had an inverse relationship. Let me make sure I'm saying this right. Risk of assessing control risk too low, otherwise known as confidence level, had an inverse relationship. Tolerable deviation rate had a inverse relationship. And then expected deviation rate had a direct relationship. Population size does not affect sample size for an attribute test. We're going to see that account balance for a substantive test is a significant factor in determining sample size for a substantive test. Okay, in determining sample size for a test of controls, an auditor should consider the expected deviation rate, desired confidence level, and tolerable deviation rate. Those are the three elements. Population, not so much, but those other three that I just laid out a minute ago, yes. The controls deemed to be more important than thought at the time that attribute sampling parameters were set. So what happens? I'm sitting here and I'm looking at control and I'm obtaining understanding. I look at the design, look at the implementation, and I say, I don't know that that control is that important. So I set control risk at, say, moderate. Then I sit there and I say, you know, the more I look at this control, the more important I think it should be. I'm going to want to have a low control risk for this. So I really want to make sure that this control is what is operating. So my tolerable deviation, I just gave the answer. So my tolerable deviation rate has to what? Has to come down, doesn't it? Because I now think this control is a pretty important control. So as you move along in the audit and you start to understand things a little bit better, you can adjust these items accordingly. But when you do that, you have to do that in a scientific manner to say, you know, I want to bring that tolerable deviation rate down to low. Or let's say you're sitting here and you're starting to discover that this control is pretty good. Well, now you can bring that tolerable deviation rate down to what? To a lower level, but you're going to have to do what? Increase your sample size, right? Now, I think it's important though to realize that if you were sitting here and you had set up your sample in a manner where you were going for, say, the low tolerable deviation, low risk, and so you had a lower tolerable deviation rate, and so you set your sample size accordingly, okay? And then you came back and your deviation rate fell in here, okay? Sometimes students will say, okay, well now you can slide down to moderate. No, that does not work that way, because you set up your whole sample, what? You set up your whole sample in a manner that what you thought you were here, and then your results came back and said, no, you're not here. Well, you don't get to then come down and say, oh, okay, well then I'm here, because this would have what? involved a smaller sample size, you already took a larger sample size. That now gets you into a world of ignoring information you have that's telling you that you have a problem. That's not how it works. But if you were down here and you came up and you said, you know, I didn't find any deviations. Well, now it would be okay to come up here, pull more sample items to go for what? Go for a lower assessed control risk. But it would not be appropriate to start out here and then have your results turn out here and say, okay, well, now I'm at moderate, because you've got more evidence that tells you something else at this point. And so at that point, you'd say, no, I've blown the control test. Now I'm going to have to, and again, you could increase the expected deviation rate and expand your substantive testing from there, meaning I'm going to pull more items now to try to get myself to where I'm still supporting a 4 to 7%, a moderate. I'm still going to, because my tolerable deviation rate wouldn't change there, but I'm still going to have to pull more sample items because my expected deviation rate is gone up. But the key important part here is you can't sit there and say, well, if you end up down here, you know, you wanted to be here, your deviation rate's here, so just come down here. No, you don't do that. That you can't do. Okay. Okay, where are we now? It'd be like if you were building a bridge, just to maybe go, maybe I'm going to keep going with this one, I should stop. But let's say you're building a bridge and you say, well, you know, this bridge could blow down if the wind is at 40 miles an hour. So you test it at 40 miles an hour, and you know, you say, I don't want the bridge to blow down at 40 miles, with winds at 40 miles an hour. So you test it at 40 miles an hour and it blows down. So now you say, oh, okay, well, you know, that's all right, because let's go for 30 miles an hour for the wind. Oh, okay, it survived with 30 miles an hour. Well, okay, but you already set this thing up. It shouldn't be a 40 miles an hour. Okay, so you know, you got to be careful that once the test doesn't do what it's supposed to, then you're sort of making steps, not lowering your standards. You're taking steps that are going to allow you to make corrections that will meet the standards that you want it to. Okay, I don't know how great that example is. I don't think I'm going to get any prizes for that example, but anyway, I think you're getting the point now, though. Any question on that? Okay, I think you determine, yeah, these are the factors. Okay, and this was the one we looked at. Okay, so we're now at the end. Okay, all right, good. So I'll tell you what, guys, rather than sit here and start chapter 9 and not be able to finish it and have to start over, you know, next time, and I probably have to start over anyway and review everything for chapter 9, just focus on chapter 8. I'll have the lecture up pretty quickly. I should be able to get that up tomorrow. You see the homework there for chapter 8. And next time we should be able to get through chapters 9 and 10. I have a feeling we're going to lose one chapter for the midterm and have to push that down to the final because it's sort of one chapter behind, because I'm pretty confident we should be able to get 9 and 10 done next time. Okay. All right, guys. Any questions, concerns? And I'll put up the information for that that little paper. Okay. Okay, guys. Thank you. We'll see you next time. All right. Have a good evening.
You.
Thank you.
Thank you.
Thank you.